Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cold and rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. I was interviewed earlier today, was asked about technical analysis, why it should work, right? Why do these lines and patterns on a chart and signals make sense? Why should they even have value? And what I explained to them was I felt that price was a reflection of investor psychology and not just what investors are thinking or feeling about the markets, but the voting they're actually making with their capital, right? Buying and selling decisions are motivated by the emotional state of investors and their long-term and short-term goals. Those buy and sell decisions are aggregated into price action. And so by analyzing price, we're analyzing the behavior of different investors. And I would say if there's nothing else you know about the market environment, study what people are doing, because trends and momentum and breadth conditions all speak to the changing sentiment of investors. We're coming off of an incredibly strong fourth quarter of last year. Now the beginning of 2024. So far, a bit muted, I would say at best. But what we'll find on today's show, there are some stocks doing just fine. There are stocks breaking out to significant highs, breaking out of major bases in some sectors that you'd expect, like technology. Other sectors that you may not expect. We'll highlight some of those as well. We have a great guest today, by the way, Julius de Kempenaer, founder of RG Research, expert in all things rotational. We'll talk about different asset classes. We'll talk about sector leadership and laggarship, where some of the opportunities might be as we sort of navigate early days of January 2024. With that in mind, let's get to our market recap and focus on what happened on the charts today. Before we get to the charts, we do want to mention a poll question that we had recently. We asked you very simply, which FANG stock, out of the 5 FANG stocks, which would you be most comfortable shorting here? Okay, and that's important. Not which one would you like to own the most, which one would you like to bet against if you had to pick one of them? Meta, Apple, Amazon, Netflix, and Alphabet. The most common response was Apple, followed soon after by Netflix and Meta. This is an interesting one, and again, just thinking of it in terms of shorting as opposed to long ideas can be a nice little a way of shaking your thinking up a little bit. What I like about this answer, Apple, to be honest with you, if you look at the 5 stocks that we mentioned, right, the 5 sort of traditional FANG stocks, basically a subset of the Magnificent Seven, I guess is how we would think of it now. Apple's the only one where the 200-day moving average is actually very much in play right now. The rest of them are either making new highs, charts like an Amazon, for example, right, sort of testing that new high and have already made a new high in the last couple weeks, or it's something that's maybe testing resistance, maybe just starting to break out, or you're sort of well below previous resistance, and there are very few of these mega cap leadership stocks that are in that final bucket, but Apple is one of them. Out of all of the 5 stocks mentioned there, this is the only one, or this is certainly the one with the weakest RSI at the moment, having just come out of that oversold region and still down in that 40 range. So it's interesting about this right now. Would I be comfortable shorting any of these? Probably not, just given the fact that the average of one of these patterns either has pulled back a lot already, which is what's happened to Apple. It's come down to its 200-day where it has bounced before, if you look back over the last couple months. But compared to some of these other ones that are in clear positions of strength, right, charts that are actually breaking to new highs, and Netflix above an upward sloping moving average, Amazon again above an upward sloping 50-day moving average, Meta above and just testing new all-time highs. Alphabet's the last one, still above there. Apple clearly the outlier. So I would probably agree with Final Bar Nation. I think that's a decent pick. Again, with all of these, it's not just about thinking about which one you'd be most comfortable shorting, but is it the right time to short, right? What level would you need to break? What signal would convince you, okay, not only is it a good opportunity, but it's a timely opportunity, right? The thing is happening right now. So maybe the 200-day moving average, as we bounce off of here, let's say the 200-day fails, that could be an interesting option for something like Apple. Great way to think about and sort of shake yourself out of behavioral biases that might be in your trading, to think about a group of stocks or ETFs in which you'd be most comfortable shorting and start to think about the downside potential in some of those names. All right, let's get back to the market recap. Look at what the major averages have done here today. The S&P 500, the NASDAQ, basically a choppy sideways session, I would say, for lack of a better term. The S&P finishing slightly lower, just below 4760. We'll call it 4757. The NASDAQ Composite just slightly higher. I'm talking 0.1% higher, so not much different from Monday's close. around 14,860, we'll call it. The Dow a little bit further to the downside. Mid caps and small caps underperforming large caps today, with the S&P 600 small cap index down 1.1%. The Nasdaq 100, again, one of the few indexes on the front page here, finishing slightly higher. And it's worth noting the VIX is coming back a little bit. We've talked a lot about, when the market has a certain character, right? When it has a certain trend. I would argue overall, if you think about the market being very strong in the fourth quarter, now sort of a question mark, pulling back a little bit, and certainly choppy in the beginning of January. An increase in volatility would be one of those sort of red flags that would tell me, okay, maybe we're due for a little bit further of a pullback or a little more painful Q1, as if the VIX starts to push higher. We're not really seeing that yet. The VIX still down in 12 handle. That's very low relative to recent standards for sure. Compared to the last couple of years, this is incredibly low. Even back, if you go back to sort of 2016, 2017, especially sort of those nice, slow and steady uptrends, the VIX was sort of down in that single teens or low teens, upper single digit sort of range, right around 10. So we're kind of right in that period. We're right in that low volatility, nice uptrend phase. So VIX going above 13, 14, 15, that's where it starts to feel very different than the recent period of strong markets and low volatility. Interest rates, we're starting to see some movement here with the 10-year yield pushing a little bit further back to the upside. It's around just about 4% on the 10-year yield. The 30-year yield is down just below 4.2%. The 5-year yield just below 4%. So when you think about it, right, the rally that we saw in the fourth quarter in November and December saw rates coming down quite a bit, right, with the 10-year yield coming from 5%, much, much lower. Now we're pushing just back above 4%. So I think one of the maybe danger signals for certainly for growth stocks would be rising rates. Now let's keep in mind that does not mean if rates go higher that growth stocks are going to struggle. As a matter of fact, just look last year, 2023, you saw periods of time where rates were going up and stocks were doing just fine. So these things don't happen in a vacuum, but generally speaking, higher rates don't tend to be good for growthier stocks, and our benchmarks tend to be dominated by growth. Bond prices, of course, have come down a bit as rates are going higher. The dollar index up about 1/3%. That's on the UUP, which is a bullish dollar ETF. Looking at metals and other commodities, you see gold flat for the day, silver slightly lower, copper down a little bit more. Crude oil prices actually pushed higher. Natural gas, the big winner on this front page. Energy stocks is really not good though, and even though you had a bit of a bounce here, I would say the crude oil chart still remaining below trendline resistance. If you look at the last couple months, I'd have to see quite an improvement in crude oil prices to feel that energy is a good opportunity. At this point, still weaker than most other sectors. Bitcoin sort of flat after yesterday rallying pretty consistently through the course of the 24-hour trading session. Today, kind of stabilizing right around 47,000. Seeing a bit of a spike here as we're recording this right after the U.S. market close on Tuesday. Bitcoin currently around 27,500, just slightly below that. That's up about 1% from yesterday. The rest of the top 10 coins that we track are down from yesterday's session, but keep an eye on Bitcoin. Obviously, a lot of speculation about ETFs being approved, what that might mean. Recently, we've seen a bit of a fee war or a price war between the different spot ETF providers and what sort of expenses that they were going to be projecting. It's getting going to be cheaper and cheaper, I think, to actually get a spot Bitcoin ETF when all is said and done. But still waiting for those headlines to drop that an ETF spot ETF in the U.S. is approved. Finally, looking at the 11 S&P sectors, again, today's guest, Julius de Kempenaer, one at the best, is helping us make sense of sector rotation. My observation, days like this, you're seeing consumer staples at the top of the list. We've seen things like REITs, utilities at the top of the 11 S&P sectors on random days. Technology was number 2 today, and that's actually been pretty rare. A lot of times it's been a little bit lower on the return list. And healthcare, if you watched our top 10 stocks to watch for January 2024, that was a special I did yesterday with Grace and Rose here at Stock Charts. There's more of a healthcare focus than I thought we were going to have. We actually don't talk a lot about our names until we sit down at the table today and kind of compare notes. And we both kind of ended up looking at healthcare, financial, some of those sectors that have been underperforming but starting to improve a little bit. So might dig into some of those in a little more detail through the course of today's show, time permitting. All right, let's look at a daily chart of the S&P and just see how things have played out today. As I mentioned, kind of a choppy session today. So after yesterday's big move, right? Tuesday was sort of a nice rally off of a swing low. We made a higher low around 4,700. That's from coming out of the New Year holiday, coming out of the first week of trading. Now we're sort of bouncing up a little bit. Monday's session, obviously a nice up day. Today ended up not really gaining any additional ground to the downside. It wasn't big a loser. You actually saw buyers come in earlier in the day, and overall ended up being not much of a change from Monday's close to Tuesday's close. As you look forward through the course of this week, keep an eye on Thursday, which is when we have the monthly CPI figures, jobs numbers, and so forth. That's sort of the next big economic data we get. Friday, you have PPI reported before the open, and that's also when earnings season really starts to heat up. A lot of financials, banks, I'm trying to think like Blackstone, BlackRock, maybe, and others, all reporting on Friday. As we get closer, we'll talk about some of those charts and those setups. But, wouldn't be surprised if it's a little choppier holding our ground until we get to Thursday and Friday between inflation data, between earnings for banks. This is where a lot more potential catalysts will come out. A lot of those before the open, which means the trading day is when we digest and make sense of those announcements. So keep an eye on the calendar there. Overall, I mean, the S&P, of course, still holding up well. I tend to go with what I call a line in the sand approach on any chart that I'm looking at, particularly one that's going up. I like to have just a very simple line in the sand. As long as we remain above level X, things just aren't getting that bad. And if we start to pull back a little bit, as long as we hold that level, again, it's just not that bad because we're holding that first sort of level of support. For me, 4,600 is probably that level on the S&P. That's the breakout level from July. That's where we broke above in early December. The 50-day moving average is kind of right below there. And a lot of the mega cap names have actually pulled back to that breakout point too. So I think that's a really interesting place to watch, sort of the previous swing high from kind of summer, fall of last year. Now that we've broken above those on charts that we have, do we hold those on any pullback? That's one of the basic sort of litmus tests as to whether a bullish phase is still in good shape. Let's talk briefly about interest rates. Again, I think the 10-year yield is one of the more important charts to pay attention to last year because it really told you about the really tracking the course of the Fed's rate policy changes. Now, of course, in 2024, most likely a very different experience. Instead of talking about persistent rate hikes and what they mean, we'll talk about a glide path of rates coming down as the Fed at some point starts to lower rates, what that might look like and how that affects equity prices. The 10-year yield for now, from the end of last year to where we're at now, up we'll call it 20 basis points. That is from 3.8% to just above 4%. The 10-year yield's right at its 200-day moving average. I think rates going above 4% all of a sudden starts to feel a little different than what we experienced in the fourth quarter, which was rates coming down, pretty much pricing in that the Fed was done hiking rates. And as we know, the equity space, certainly growth stocks, thrived in that environment. Wouldn't be surprised if we get a little different feel if rates continue to go higher. All of a sudden, it feels more like sort of July, August, September of last year. Very different feel for equities. Let's look at a couple individual stocks to wrap up our market recap, and then we'll hit today's guest, Julius de Kempenaer. I have to highlight names that are breaking out. I mentioned the top 10 charts to watch for January 2024. And again, don't forget to go watch that video next if you're on our YouTube channel. That's a really, really good discussion with Grayson Rose about where some opportunities could be here through the month of January. One of the 10 stocks we talked about was NVIDIA, and we talked about upside potential as NVIDIA is able to eclipse $500 a share. That was a resistance level we reached in August of last year. We retested that in November, retested it again in December. And every time you keep testing a level of resistance, I think that further validates the importance of that level. And when the market finally breaks through it, usually can be a pretty encouraging sign. In this case, this week, NVIDIA finally powering above that 500 level now for the first time. And I think the conditions overall in NVIDIA certainly speaks to the strength of that particular stock, speaks to the strength in the semiconductor space. We're finding a lot of charts that are holding up pretty well. How bad are the markets going to be, or the equity markets going to be, when major semiconductor names like NVIDIA are breaking out? There are plenty of things that could go down in that scenario, but it tells me that things just aren't going to be that bad as long as an NVIDIA is making new 52-week highs. And that's where we're finding ourselves. And it's not just NVIDIA, right? If you look at CrowdStrike in the same sector, obviously a software name, also a new 52-week high today, up almost 5% today. And that's after gapping higher yesterday. Today's move actually completes that rotation to a new 52-week high, getting above 260 a share, which was where we were at in mid-December. And again, a lot of these stocks becoming overbought, a lot of them certainly feeling fairly extended after a pretty good run. But remember, an uptrend is a pattern of higher highs and higher lows. And I've learned to identify trends and follow those trends. As long as it keeps making higher highs and higher lows, which a chart like CrowdStrike certainly appears to be doing, that's a chart in an uptrend. That's something to be followed. Let's finish off talking about a couple more of those Magnificent Seven names. And again, in our poll recently, we asked you about which one would be you'd be comfortable shorting. It's tough with a lot of these in pretty good uptrends. If you look at Amazon, just pulling back to an ascending 50-day moving average, bouncing higher now. That's what we call a fat pitch chart. And if you know baseball, that's a pitch right over the plate that you want to take a swing at. So we made a new swing high. The longer term trend, pretty positive. We've pulled back in the short term, which gives you an opportunity to buy in on the weakness or buy on the dips. And now that strategy appears to be working pretty well with Amazon up another 1.5%. Microsoft kind of in a similar condition. You saw the new high in November. We've been sort of choppy sideways, and around 365, we'll call it, has been short-term support from early December through really early January. Now we're sort of bouncing again off of that 50-day moving average. I'd love to see if this could break to a new swing high above 380. But overall, it's in a pretty good condition. What's interesting about the chart of Microsoft and a lot of these other names, by the way, is if you look at the high from this summer, July is the high here. If you connect that to where we're at now, you can see the support that we've experienced recently lines up really well with that previous high. That's a technical concept called polarity, where resistance becomes support and vice versa. So the fact that we're holding support right at the previous breakout level, I think is pretty encouraging. For now, the 50-day holds this previous support holds. This is a pretty good chart. We break below 360. I think this chart starts to look very different. You need to think about weakness in Q1. But for now, the chart of Microsoft is saying things just aren't getting that bad. That's it for our market recap today. A lot of charts to talk about, just highlighting some of those key names and patterns that I think you need to be aware of. We're going to bring on today's guest, Julius de Kempenaer, here in a few moments. Before we do so, just one quick announcement. As a reminder, we love hearing from you, particularly for our mailbag. Our mailbag is driven mostly by email and comments here on our YouTube channel. Our email is a great way to get your questions to us, thefinalbar@stockcharts.com. On Twitter, give us a follow at FinalBarSCTV. And here on YouTube, of course, make sure you like this video and subscribe to our channel while we're here. We're almost to 100,000 subscribers. What an awesome milestone for Stock Charts TV. It's been so fun to be part of this success story, and we hope to help many, many more investors make better decisions. You can help us along the way by subscribing to our channel here and watching more content on Stock Charts TV. I want to bring on today's guest, Julius de Kempenaer. Julius is the founder of RRG Research. He's a senior technical analyst here at StockCharts.com, coming to us live from the Netherlands. Julius, good to see you. How are you?
I'm good, Dave. Thanks. I'm glad to be back here.
It's good to be with you. I saw you a couple weeks ago, right? We did our Charting Forward special at the end of last year. That was a lot of fun. I appreciate you being a part of that. Three kind of different perspectives, but we talked a lot about rotation. We talked a lot about themes that we observed last year and what sort of expectations we could experience here in 2024. We're starting with just sort of thoughts about overall asset allocation. Where are you at as you observe these markets early days in January? What does this give you a sense of things to come here in the coming weeks?
Yeah, so the RRG that you've got on is the one that I always use for asset allocation. It's a predefined group, has a number of ETFs that tracks various asset classes, and you can see that it's pretty distorted right now because of the Bitcoin price that is way up inside the leading quadrant. There is no doubt about it that Bitcoin is or if you want to use it as a proxy for cryptocurrencies, crypto is a very strong part of the market right now. So if you tick off the checkbox for Bitcoin and then click on fit or center, then you will get, there you go. Now we got a little bit better handle on what's going on in the rest of the world. And what you see there is actually quite interesting because you see all these red tails moving into the lagging quadrant at a negative heading. There's one inside improving, that's corporate bonds, LQD, which is rolling over and basically not doing much. But the most interesting tail is the one for SPY, that is obviously representing the stock market. and that is rotating back into the leading quadrant.
Mm.
And the interesting thing is that basically what this tells you is that stocks are the preferred asset class at the moment. They are on a relative uptrend versus, I use VBINX, which is a Vanguard balanced index fund.
Right.
Uses 60% stocks and 40% bonds. And the bond section is governments, high yield, and corporate bonds. So it's a pretty broad, balanced index. And what you see is that stocks are outperforming that index and all the other asset classes. So that's a good thing. It's a good message for stocks. Now, what it doesn't say is that stocks will go up. And that's where a lot of people make a mistake when they look at relative strength in general. When a relative moves higher, it just means that the one security or the one asset is doing better than the other, which means that if the market goes down 10% and SPY goes up 5%, goes down 5%, it's still outperforming the market by 5%. So that's one thing that you really need to be aware of. Now, the interesting thing is that when you change the time frame for this chart to monthly and or daily, so we're looking at weekly now, change it to monthly. There you go. You see kind of a similar trend. You can see SPY moving up into that leading quadrant and all the others moving into lagging. And then you got Bitcoin up there.
Right.
And if you do the same for the daily RRG, so make it daily, yeah. Again, there you see SPY moving into that leading quadrant. And the others are either in improving or rolling over, but they are not nearly as good as SPY. So all in all, this tells me that on all three time frames, the stock market or stocks are outperforming the benchmark and the other asset classes. Again, not necessarily meaning that stocks will be going up in price, but it's definitely not a bad scenario, because if the stock market were to be, go crash or do something really stupid, this RRG would look different. You would see bonds picking up strength. You would see commodities picking up strength. You would see stuff moving out of the stock market into other asset classes. That's not the case right now. So I'm in the camp where I think that the S&P is ready for a little correction.
Yeah.
But I'm in the camp like it's gonna be bad, but not that bad. And that chart. When you were playing with that, I was thinking like I can project, or in my head project, a small head and shoulders pattern to be formed there, where today's high and yesterday's high is going to be the right shoulder.
Yep.
That has the neckline about, what is it, 46 something.
Yeah, it's about right.
And if you project the target down, it's coming back to the line in the sand, which would be a perfect alignment of stuff. So you got your little peak, you got your little bit of a digestion recovery after that big rally. You go back to your previous resistance, now support, and from there we continue the overall uptrend, which I think is still in play.
Yeah, one of the charts you mentioned before, we were looking at this one, Julius, which is the SPY versus IEF, which is a Treasury bond ETF. And we're looking at the last 3 years here. And to your point, whether or not stocks are going up on an absolute basis, even as they're chopping around here, it's still very much favoring stocks over bonds, certainly over the long term, right?
Absolutely, yeah. And this is all-time high levels. If you can make that as long as you wish.
Right.
We're at all-time high levels. So that is a good thing. So from every angle that I look at this asset class constellation, stocks come out on top. And again, not necessarily meaning that they will go up in price tomorrow and next week.
Yeah.
But it doesn't look that bad.
So with this current configuration, right, looking at the daily or the weekly RRG, what would you need to see to think, okay, now we really do need to get more defensive? I would assume the SPY, which is in the leading quadrant on all three timeframes, probably starts to exit that, and some other things start to look a little bit strong. I mean, is that generally speaking what you'd be looking for here?
Yeah, I generally take a top-down approach, so working from the longer time frames to the shorter. So the first time frame where you will see stuff rolling over will be the daily. So exactly what you said. You will see SPY going inside leading, not making it, rolling over, going into weakening, start moving to lagging, and then maybe it starts to drag weekly around and stuff. So yeah, first weakness shows up on the dailies, probably in the form of moving from leading into weakening. Depends a lot on at which level of the RS ratio it will happen. If we are in a situation where SPY moves all the way to the right and then all of a sudden needs to make some sort of a high-low rotation, goes from leading to weakening and back up to leading, you won't even see that on the weekly. So you gotta, if you play around with it, you got to feel for the interaction between the time frames and how they interact with each other. And right now it looks all pretty strong. And as you said, the first thing that you want to see if you want to look for negatives is for SPY to start rolling over inside the leading quadrant.
Just with the time we have left, Julius, I'd love to talk a little bit about sector rotation. Obviously, growth stocks, did incredibly well in 2023. Value-oriented sectors started to improve a little bit there at the end of last year. Now, as we start 2024, what are your observations at a sector level?
So, at sector level, you can see how confused, I think, is the right word. There's not a very clear direction. Sometimes there's very clear directions from a sector perspective, and that's not the case right now. If you would put a weekly and a daily RRG side by side, don't do that right now. But if you would do that, you would see that there is a ton of sectors where the weekly tail is going one way and the daily is going directly the opposite. Which means that there is some sort of, we're in this trend, but we're correcting. And some sectors are in a relative uptrend and they're going into, a little bit of a correction. Some sectors are in a relative downtrend and they go into some sort of a recovery. What is interesting to see is that you got the weekly here. And one of the metrics that I keep an eye on is the rotation of defensive sectors. They're very well defined: staples, utilities, healthcare. And if you look at staples and utilities, they're inside improving, but rolling over, and they're at low levels. Yep, that's the one. And then you got utilities right there. If you bring up healthcare, it's a little bit ahead of those three, and you will see it's inside lagging, but it's hooking back up. So it's kind of shrugging off that real negative view. Now, if you bring up the daily version of this RRG, you will see that last week was all about a rotation to defense. You can see staples, utilities, and healthcare all at very strong trajectories, together with financials, and all the others were moving the other direction. Again, aligning different time frames, what you see here is that healthcare is the only sector that is now aligning with its weekly of the defensive sectors. So I'm interested in looking at healthcare stocks. The other sector that is doing exactly the same is financials. Financials rotated from leading to weakening, and they're now pushing back into leading, while the weekly tail is already inside the leading quadrant. So out of all these sectors, there's only healthcare and financials at the moment that are moving in a similar direction, making them, investable or tradable. I guess that's where if you're looking for long positions, that's where you want to look right now. You can look everywhere else, but it's going to be a lot more difficult to find the best of the best. And in healthcare and financials, we can certainly do that. And we talked before the show, and we both ran into Gilead, GILD, which is one of the stocks in the healthcare sector. And it's doing phenomenal. It's breaking out to new highs. It's exactly following the RRG tail, and you got a really good price chart. So this is one of the stocks that I would certainly have on my buy list because it's just ticking all the boxes, both from a relative and a price perspective. And if we have time for one more, I would go into the financial sector and highlight FIS.
Yeah, right.
There
Big rotation off the lows there.
Yeah, very nice base. You can if you bring up the financials on an RRG, you will see that FIS is in a really strong trajectory. And again, RRG should not be used as a standalone system. It's a great overview system. It's a great tool to identify where you want to look. But in the end of the day, you're buying price. So you always need to bring up the price chart. So just by looking at the sectors, I identified healthcare and financials, and then doing the same exercise, bringing up the individual stocks on an RRG, I could very quickly spot FIS in financials and Guild in healthcare as being very interesting stocks to look at from a buying perspective. And you can see how FIS is coming out of it's like it's not a year, but like 9 months of sideways trading, pretty well defined between, what is that, 60 something, 62, and then 40, 46.
Yeah.
Classical technical analysis, we can project that height of that range to the breakout level. I'd say that's a tradable opportunity.
Julius, this is well done, starting with the top level, the asset allocation, looking at sectors, focusing on a couple individual ideas. As you were talking, it made me think you and I are going to be in Dubai here next month in February doing a presentation together. Maybe that was our presentation. We might riff on that a little bit, but that was a fun kind of journey. Maybe we could check that one off now, huh?
Yeah, we may need to change some of the individual names because time will have changed, but there.
We'll start from there.
There's one more thing. Yeah, one more thing before we go though. Mm-hmm. You were talking about inflation stuff and how everything got cheaper and cheaper with the Bitcoin ETF. Like everybody's talking about inflation and stuff is getting more expensive. In all my 30 years in the financial markets, commissions, trading costs, ETF costs, fund costs, they're all going down. So there's no inflation in the financial sector.
Yeah, for investors, right? It's cheaper than ever to access the markets. That is undeniably true, and that trend does not seem to be changing anytime soon. Julius, we'll have to leave it there. Listen, great to see you. Have a great night. Thanks for joining us from the Netherlands. We'll see you again soon.
Thank you, man. Bye-bye.
That's Julius de Kempenaer. Julius is the founder of RRG Research. Again, what a pleasure to talk to someone like Julius, which I've been able to do for quite some time. And thinking about the rotations and thinking about the levels of your analysis, right? Starting top level, stocks versus bonds versus commodities. What are those relationships? All right, let's look at sectors and how they're doing relative to those broader expectations. Now let's look at some of those sectors showing some opportunity, look at some individual names and groups. Replicate what Julius just did in that little 10-minute segment as part of your normal process. I think you'll find a lot of success on stock charts as an investor. Great take there by Julius de Kempenaer, as always. We got to wrap the show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. You know, mid caps and small caps lagging a little bit behind large caps today, and that's been a phenomenon we've been talking about quite often here, really from last year, where small caps were really not in the driver's seat. Mid caps as well, right? It's been large over everything. And that was one of the great points that I think Julius de Kempenaer provided in our charting forward discussion and some of his appearances in December on the show. We talked about large over small as a key theme. You know, is that starting to change? I think one of the places you would see that will be something like a mid cap ETF, which is ticker MDY, breaking out of resistance and holding that. Now, this sort of general pattern where you have resistance from kind of June, July, we've now broken above it and now testing it from above. This is a price gap that you see in the mid-cap ETF there in early December. If this holds, this might be a good reset and maybe stronger expectations or stronger performance than we might expect given the seasonal weakness you usually see in Q1. With something like the NDY breaking a little bit lower, below 490 we'll call it, I think that tells you that maybe this breakout was a false one. So I think we're right at that sort of crucial point, right? Do we hold this level of support or not? That's what I would be watching the MDY right about now. We talked about some of the leading growth stocks, the Magnificent Seven. Netflix was one of the charts that we brought up. And again, I love to look at sort of different lists of stocks and just bring up the charts one by one and see what jumps out at me. And as I was looking at charts like Netflix and some of the other leading names, I'm concerned by a bearish divergence that I'm seeing. And it's not just in these names. You're seeing in other sectors as well. That's when you have higher highs, November and December in this case, and lower momentum. We're overbought on that first high. We make a new high in price, but weaker momentum. And that often suggests an end to that move. Now, Netflix has now broken down through trend line support. So all of those are kind of negative developments, but it really hasn't broken down that much, right? We're still holding the swing low from December, which is around 445, 450. You're still holding the 50-day moving average. So at this point, I would say those mega cap names are sort of bent but not broken. And I would be thinking about what levels would tell you this is really starting to get concerning. I'm not seeing that breakdown just yet. Finally, trendline analysis can be a very simple but powerful visual technique to sort of quantify the trend, the pace of the trend, and then identify when that pace is changing. If you look at the crude oil price, which is $WTIC on the stock charts platform, start with the high in September, connect that to the high in October. You find that lines up really well with the highs in December and now again from the last week. We've sold off here this week so far, coming off of that trendline resistance. I'd be looking to see when crude oil can break above there. Until it does, I'm not that excited about looking at something like energy stocks because that's probably a play on higher crude oil prices. But we are approaching a major support level from the first half of 2023. So one of these things is going to happen. Crude oil keeps going right through support, or it holds it and probably breaks that trend line to the upside. I'd watch this chart to see which one of those things actually plays out. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. Special thank you to Julius de Kempenaer of RG Research joining us from the Netherlands. Don't forget to like this video and subscribe to our channel while you're here. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.